With the S&P 500 trading at an all-time high of 5,026, it's becoming extremely hard to find any kind of value in the market, and this is why I try my best here on YouTube to give you some of these stocks within my 2 stocks to consider. I do 3 different videos of those on YouTube every single month. You guys enjoy them, but even in my portfolio, I've been buying a lot of the microcap stocks. I shared some of them on the TSX Ventures, but some of them have been flat for like 8 or 9 months, and now they're suddenly getting massive inflows. So everything is really catching up, and these stocks are up 20-30%. One of them is up around 120% in my portfolio. But a lot of these things have been catching up, and you have a lot of the expensive stocks. They're too expensive, and they priced in years and years of returns. But you have the cheap stocks, which most of them are value traps. And in this video, I'm going to discuss a stock that I used to own before, and I talked about it many times on the channel. You guys are familiar with it, and this stock is CVS Health. It's still trading at 9 times earnings, which could be some kind of a bargain if you compare it to other stocks that you have in the market. It could also be a value trap. This is why I'm doing this video, to analyze it. But CVS, it was one of the main stocks I used to talk about on YouTube. I was very bullish on the stock, said why CVS is too cheap to ignore and all these kind of things. Then around 6 months ago, I did a video revisiting my thesis, and I said bad news, and it was mainly because the management did not have enough confidence in guidance. And this is why I exited the stock, because my thesis changed, so I changed my opinion and I just moved on from it. But in this video, I'm going to revisit CVS. I'm going to discuss the latest earnings that just came out last week. I'm going to give you my opinion in general and tell you the upside potential that I see on CVS stock, sitting pretty close to $76 per share, making higher highs and higher lows. So this is, a bullish signal on the stock. It could be bottoming out. But in terms of CVS, EPS per share, they did beat on earnings, 212 versus 199, pretty good. Revenues, they also beat by around 3.4 billion. This is pretty good from CVS. They've been most of the time missing on revenues lately, but this one they did beat on revenues. This was pretty good. In terms of the total in 2023, this company is still growing revenues around 11%, 10.9%. It's pretty good, because a lot of people keep saying that CVS is a dying company, but they're still growing revenues pretty close to 11%. Which is great. Now, in terms of operating income, it has been disappointing. It's down 2.8%. They still have some kind of an expense problem. Adjusted earnings per share, they were down 3.2%. Cash flow for operations down over 17%. So outside of the revenue picture, 2023 has not been the best year for CVS in my personal opinion. Now, if you look at the health services, which was one of the main reasons why CVS went down, because they made 2 acquisitions. One of them is Oak Street Health, which has a lot of clinics and stuff, and the second one is Signify Health, and they were trying to mainly get into primary care and expand, the business and stuff. And this part of the business has been growing revenues around 12%, operating income around 4.2%. So it's not really bad, and guidance for 2024 is a little bit below expectations, but it's, somewhat promising for these new businesses. And they have been integrating Oak Street Health. They have over 204 stores. And in terms of the number of Aetna members, which is their insurance business, they have signed up to join Oak Street Health clinics, has more than doubled. So they are finding synergies, they're finding ways to grow the businesses, and it could end up being a very smart acquisition from CVS Health to become vertically integrated. They've been talking about this for years, to get into primary care, and they finally did it through Oak Street Health, and a little bit on in-home care for Signify Health. And it's too early to judge if they did overpay. We're going to have to wait and see how it plays out. Now, in terms of guidance was a little bit disappointing. This is why the stock initially sold off. Revenues are still growing strongly, of course. Operating income is lower than they were expecting on the Investors Day just in December. GAAP EPS is lower. You have to mainly look at adjusted EPS per share, because they have the insurance business, they have a lot of one-time expenses and all these kind of things. Well, it went from 850 to 830. Cash flow from operations from 12.5 billion to 12 billion. Now, this is really, really bad and it's moving to the wrong direction. And this is one of the main reasons why I ended up moving on from CVS and changing my thesis 6 months ago, was because I initially bought the stock having this expectation in mind that they could get to around $10 of EPS by 2025. And I was saying, okay, $10 of EPS trading around 12 times earnings, which is a fair multiple, $120. The stock was trading around $69 per share. And you have the dividend. This is more than a double in like 4 years. And it was very undervalued. But then in a month or two, the management came out and they said that they don't have enough confidence in the guidance. This is what I got from them. So I moved on. And if we look at it right now, 2024 was supposed to have $9 of EPS, and CVS is guiding $8.30. So the $10 EPS is far away. And this is one of the reasons why I ended up exiting the position. But in terms of CVS, they do have a lot of debt, as many of you know. They did some acquisitions, and they still have the Aetna debt when they acquired it. I believe it was in 2018 or 2017. But the long-term debt is $58.6 billion. But the company still has a lot of other debts. They have deferred income taxes, $4.3 billion, and other long-term liabilities of $5.4 billion. I mean, all these things are liabilities. So if you add them all up, it's pretty close to $78 billion. But they do have around $11 billion of cash and cash equivalents. So in total, with investments, in total would be maybe, something like, I don't know, $67 billion. It's still a lot of debt, and the interest expense is not a little on these things. I mean, interest is very, very high. But in terms of the dividend, many of you might buy CVS for the dividend. The dividend right now is pretty close to 3.5%. Many of you want to know if we're going to have a dividend cut, or maybe the dividend will be safe within CVS. Now, from me looking at the total dividend paid in 2023, we're pretty close to $3.1 billion, 3.1 billion. But if we look at the guidance of CVS, they have the cash from operations guidance of around 12 billion, capital expenditures of 3 billion, which would put free cash flow around $9 billion. So from the $9 billion of free cash flow, they can afford the $3 billion for the dividend, and they would have around $7 billion left to do maybe some buybacks and do a few other things. The company is guiding a $4 billion buyback program. So this is $7 billion return to shareholders, and I would still have around $2.5 billion to pay down debt or do whatever they want. But for me, what I got from this presentation is that, CVS is not in rush to pay down the debt. And they do have a significant interest expense, in my opinion. And I would believe the smart thing to do is to pay down the debt. But CVS, if you look at their presentation, I hope I can find it here, they are guiding something pretty close to a buyback program, a $3 billion accelerated share repurchase transactions. Now, $3 billion in buybacks, and then you have the dividend, which is around $3.1 billion. This is $6 billion. You're left with $3 billion and around $11 billion of cash. Now, for me personally, I would not have done the buyback. I would just put the $6 billion in just doing, debt repayments and decreasing interest expense, which increases free cash flow. So one of the theses that I had is that CVS would quickly deleverage, and it looks like so far that they're not planning to do it quickly. They're trying to take their time, which, it could work for them, but again, this is not what I was expecting. In terms of a market cap to free cash flow multiple, CVS is trading at 10 times, free cash flow 10.5 times. The mean was 9.8 times. So CVS is fairly valued in terms of a free cash flow multiple, mainly because they decreased the 2024 free cash flow guidance. So for me personally, if I'm not seeing any major growth in EPS, which I'm not, if I'm not seeing any major growth in free cash flow, which I'm not, I would most likely bet on CVS to not have a major multiple expansion, but to mainly trade on the free cash flow yield and return something pretty close to the free cash flow yield, which is 9.5%. So for me, on a worst case scenario, I would expect 9 to 10% return annual for CVS shareholders, including the dividend and buybacks, of course. I think it would be a pretty good return. So worst case scenario, around 9 to 10%. But you also have a best case scenario where you could get to 12, 13%. If the company does end up being able to grow EPS per share, maybe they can do it through buybacks, and maybe they can beat and surprise everyone. But I see 9 to 10% on the low end, on the high end, maybe 12 to 13% annual, which is a good return if you compare it to a lot of the expensive stocks in the market. And CVS is not going to make anyone rich. It's more of a buy and hold for safe dividend investors. But you also have AT&T and others, which I believe are undervalued dividend stocks. But this was my opinion on CVS. I don't think the company is going to cut the dividend, and I don't think they're going to go under or anything crazy. And it was just my opinion, not financial advice. I hope you enjoyed the video. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.